Pension Fund.
Hello and welcome to the third chapter of a brand new series at Financial Planner, and the lessons that we are learning today. We'll tell you what is an index, why do you need to have a demat account, and what really dematerialization means. And also we are happy to address your queries, and for that we have with us Jayant Pai. Jayant, thank you so much for joining us. You know, it's always interesting to get our facts and get our lessons, you know, being refreshed, etc. And as I just mentioned, the key things that we'll be discussing today is about, first is what is an index?
An index basically is a compilation. It can be either of stocks, commodities, bonds. It can cut across markets, like you may have global indices, or you may have indices pertaining to certain sectors, for example a banking sector or auto sector. Basically it is constructed with the aim of providing information in a nutshell. For instance, through the index value and the changes in index values, people extrapolate to movements in the entire market. For example, if you ask me, did the market rise or fall? Basically you're asking whether the index rose or fell.
So essentially, for the better understanding of viewers, they must have heard the word Sensex.
Yeah.
So Sensex is nothing but an index. Now there can be various index sort of compilation, as you said. It can be like how we say that the pharma index or the banking index has done. So it's a compilation of the banking stocks together.
Yeah.
That is a simple way of putting an index, right?
Yeah, and within that people generally choose the leaders while compiling the index. And there are several ways of constructing an index, but the most common method is known as the market cap weighted method. So
okay.
Market cap
now explain that.
Yeah, okay. Market cap is simply the number of shares outstanding into the price per share. For example, if you have 100 shares outstanding and the price per share is 100, so the market cap is 10,000.
Okay.
So the exchanges rank the shares which are listed on their exchange in the order of market capitalization and choose a certain top 30, top 50, top 100, any number which they want, and say that that is the and the index comprises those stocks. Because those stocks actually, when you see those stocks, you usually can extrapolate and say that the entire market has behaved in that manner.
Okay, so essentially what you're saying is, primarily or predominantly, when a market cap of a company is higher, it basically constitutes the part of the index, right?
Yeah.
So when you hear this announcement coming in that an X company replaces the Y company in index, it's generally a phenomena where they lose a market cap. Is that so as well?
Yes, but loss in market cap is the end result of certain other things. For instance, your loss in terms of business dominance. So when you lose your business dominance and your fundamentals become weak, so then automatically there are chances of your market cap reducing. So that this churn will keep happening. So, but market cap is one of the ways of doing it. There are certain other ways, like for example, it could be an equally weighted index. For example, Dow Jones is an equally weighted index. Then you may have things known as fundamental indexing. For instance, you don't look at market cap while constructing it. You look at the sales, you look at the gross block or profits. So you may rank the companies based on that also. So these are variants, but the most common one is the market cap method.
Okay, so essentially that is a common phenomena. Say for example, in a Sensex we are looking at a market cap dominated index. That's right.
And within that there is a thing known as the free float market cap, wherein you remove the promoter's holding and you only take into account the amount which is there with the public. So that is a more representative way of doing it.
Explain it more simply, Jayant, as to really you're talking about. We use two big words right now. We used a market capitalization, we use the free float with regard to this entire term index that we are sort of demystifying. So explain it in simple example words to the viewers.
Okay, now already we gave one example of market cap. Now free float is a subset of that. For instance, if you have 100 shares outstanding, but 60 shares are with the promoter.
Okay,
so that those shares will not come into the market that easily. They'll only come if the promoter is undertaking a distressed sale or something. So the other 40 shares which are there, they are the real
shares which will be traded, which will be sort of available for buy and sell.
Yeah, so companies which are higher on that component are given a higher weightage in the free float method of doing it. So for instance, ONGC it has a very high market cap, but when it comes to free float, its weightage falls below Reliance. Simply because government holds a larger share.
Larger share.
Yeah.
So essentially you look at two criterias in terms of when you're forming an index. Sometimes, or some indices or whatever index will look into, which is about, one, we discussed market cap. The other is what is going to be your free float. Now free float is dependent essentially in very simple terms that how much is the promoter holding in that company versus how much are the shares that are available to public for buy and sell. The higher the free float, meaning the large number of shares are there for people to buy and sell, and less promoter holding. Right?
Yes.
Okay. Now, based on that, there is an entire compilation of the methodology that is decided. Say, so for example, for a Sensex, they would have decided that we're looking at market cap free float. Based on that, they select all the companies that are listed in that exchange, and then they form the index, which is Sensex. Now, Sensex necessarily would not be representing all the listed companies, but give a reflection as far as how the market is trading, right?
Yeah, so here you don't look at the number of companies listed, but you look at their influence on the market. So for instance, the Nifty, which is a popular broad market index, tracks around 75% of the listed market cap of the NSE. So naturally, when there are movements in that index, you know, often if the leaders move in a certain way, the followers will also move. So that is the presumption. So that is the way it is done. So Nifty may have 2,500 companies listed, the NSE, but the Nifty is only 50 stocks. But those 50 play an inordinately important role in the market. So that's why those 50 are chosen.
Okay, and the same goes with Sensex.
With the same thing. The Sensex also has 30 stocks, but they comprise around over 80% of the market cap of the BSE.
Okay, and therefore the movement that they go up and down in is what reflects really the you know, where the market is moving, and therefore index gives an entire idea about the markets going up and down, etc.
There may be divergences, but broadly this is it.
Give me a sense about various other categories of an index. So, you know, like our Sensex we have, which is something we reckon with. You know, Sensex is up, Sensex is down, completely defining the markets are up. The other smaller indices are essentially sectoral indices, right?
Yes. For instance, there are dozens of them. A few are auto, banking. Banking is a very broadly followed index. Then you have the auto sector, pharma sector. You may have even non-tradable things, like for example in the US there is an index known as the Case-Shiller index of house prices. So which is compiled by taking house prices of various areas, states in the US. Some indices are also investable. By investable we mean you can actually buy and sell them in a single stroke. So you can do this through two ways. One is the ETF and second is the index fund. So this is another very important use of an index. So there are many newcomers to the market, you know, who prefer to do it in this way. And also many people, like for example, if an Indian wants to invest in some African country, you know,
so you do it in an index, which is basically, you don't have to choose what kind of stock or company you should invest in, because you may not have data or information, but if you believe the overall story of that particular you know, nation, for example, or whatever the country, then you can sort of bet on the index rather than choosing the companies for which you may or may not have an information, right?
Yeah, because these are pre-selected. So there is a certain process to select them, so automatically you may take advantage of that.
Okay, so for a new investor who's wanting to sort of go directly, I mean, we'll be discussing with the viewers, we touched briefly in our last episode about mutual funds, etc. But for an investor who's wanting to invest in an equity market, may not have a knowledge but firmly believes that equity is the way forward, could look at index investments, right?
That is a good way to begin, but it's a misnomer to say that they are less risky than other stocks.
Okay.
Because the market risk will have to be borne.
Well, on that note, Jayant, we have discussed index in detail, and we'll be taking a short break here, and we'll come back and we'll discuss that why do you need a demat account, how important it is, or what really is dematerialization? So please come back and we'll address those questions.
The Financial Planner, presented by BSC, Investors Protection Fund.
Welcome back. Now we talk about dematerialization, or why do you need a demat account. So essentially, for any investor who's wanting to invest in an equity market, needs to have a demat account, right?
Yeah.
Okay. What is dematerialization? Let's go back to the history when we were talking about physical shares.
Yeah.
And I believe some people still have those physical shares with them. The rationale as far as dematerialization?
It was basically to increase the confidence in the markets, to increase the ease of tradability, because formerly when the physical shares were used, you had a problem of the signature differing. So I bought the shares from you, but I knew after a period of 6 to 8 months that your signature does not match with the company's records. So then again there was a chain of me getting the shares back, giving it to you and all that. So that was taking time. Second, the problem of fake share certificates itself. Just like you have forged currency notes, you have forged share certificates. So all this was damaging the confidence. So basically, to attract foreign investments, we had to simplify the process.
And also availability, or essentially accessibility rather, in terms of, like, if I want to buy and sell, I have to find a buyer very easily.
Yeah, that is the function of the market. But why demat was done was basically to attract foreign investment into us, to ease the entire process of the post-trade. What you're referring to is the actual trading part, but the settlement part was equally painful. So demat was partly done for that, and everyone has benefited as a result. So for last 12 years, a lot of this market FI inflow which has come in, partly is because of the India growth story, but a lot is because the market infrastructure has improved so much. So demat is plays a pivotal role in that.
And if I want to understand, who handles the demat account? Like, we have a bank, and so we have a bank account.
Yeah.
And then we need to have a demat account. Who handles that, and how does it work?
See, the hierarchy is that you have a depository which is involved with the actual process of taking the shares and dematerializing them. So there are two depositories in India, NSDL and CDSL. But you cannot deal directly with them as an investor. They have certain agents known as a depository participant or a DP. Banks, brokers, everyone who complies with the conditions or the stipulations, they can become a DP. And the same DP can be with both also. So all investors will deal with those DPs. So the DP undertakes the actual work of taking the shares from you, handing it over to the NSDL or CDSL and helps in record keeping.
Okay, so essentially, like for a bank is there for maintaining your bank account, a depository is there for maintaining your demat account essentially.
Yeah.
But you will not be directly, as you said, be interacting with the depository. You would be interacting with various depository participants. It can be brokers, or it can be banks or other entities, right?
Yeah.
Now I want to understand that if at all I do, so there is absolutely no concept of, if today I get into the market of having a physical share.
No.
Right? So if somebody has a physical shares, because there will be a lot of viewers or other people who probably would have inherited some shares, some may be in a physical form, how do you go about changing that?
So for that you have to go through this process called dematerialization, and there is a form known as a DRF, a dematerialization request form. You fill in the relevant details, attach the certificate to that DRF, hand it over to the DP, who will then forward it to the depository, and within a week or two you will get an electronic entry. It's like a passbook. So like your passbook is updated, your DP account will be updated with the entry. So that is one thing. Saying
that, okay, you had physical shares of this, but there would be some verification that would be required about that particular share certificate, right?
For that it has to go to the company. So you're right. So for example, the signature on the DRF has to match with the signature in the company's records. So that is one more filter which is used.
Okay. Well, you may still have a whole lot of questions as far as demat and depository is concerned, and we promise that we will address all those basic queries that you may have. You know, how do you open a demat account? What are the things that you need to do as far as opening a demat account? But those are the questions that we'll be addressing in detail in our subsequent episodes. We will take a short break, but we'll come back and address your queries when we return. Thank you for watching.
The Financial Planner, presented by BSC Pension Fund.
Welcome back to Financial Planner. It's time that we take up your queries.
Investment Ladder, presented by BSC Investors Protection Fund.
Well, Jayant, we have a query from Sudha from Bangalore, a very interesting query, because Sudha is caught in a situation where she has about 18 lakh rupees of net cash that is available, you know, based on the ESOPs and the savings that she has done. And the basic question that she has is whether she should be using that amount of money in terms of payment for her home loan, which she has jointly with her partner, or should be looking at investing this surplus somewhere else and, you know, seeing the money grow. So she has also sort of outlined various you know, she said that she's getting benefits as far as home loans, etc. is concerned. But what is the advice that you'd like to give for not just Sudha, but people in general who are caught within this sort of quandary as to whether should the surplus be used for prepayment of home loan, or should the surplus be invested?
See, I feel that debt is as much psychological as it is financial. So, you know, it's a burden on your head. So you should try to prepay it as whenever possible. So in Sudha's case also I would suggest the same thing. And yeah, obviously this dichotomy will be there. But you see, one thing is clear, that the debt is a very real liability. But the investment returns are something in the air, you know, you're not sure. So, and all the fixed return investments are usually, they offer lesser, they give you lesser returns as compared to your interest which you're paying. So equities may give you higher, but that's over the longer term with a lot of volatility. So I always say that you should prepay, and also now you don't even have to pay prepayment charges for the past 6 months as per RBI and NHB. So if you have your own savings, please prepay.
So essentially right now, you know, as it seems that Sudha's loan is a floating rate loan. We're going through this interest rate cycle as well, where a lot of high interest rate has gone up really high. We've had 12, almost 11 cycles of higher interest rates and so on and so forth. And given that, and also RBI's little sort of boon in terms of that there would not be a prepayment charges, so it would be advisable for her to therefore go for prepayment, and investments can come. I mean, first the debt should go as far as financial planning, you know, sort of principles are concerned. Okay, let me on that note get across to our next question, which is from Saurabh Kumar. He's just completed his graduation and started working in Wipro. Can save about 5,000 rupees per month. He wanted to know how to start in the share market. That's what this show is about, to guide as to how to start there, and wants to know that in this volatile markets, where should I invest my money, where should I save some amount, and where should, you know, essentially should start, take the first step forward. So essentially, volatility, share market, young, good thought in terms of you know, starting early and thinking about investing. Your advice?
Yeah, certainly. It's very good that he wants to start, but I suggest he does not start in the equity markets directly, because you require a lot of information and study for that, which he may not have the time and the inclination to do. So the next best option is equity mutual funds. And yes, markets will always remain volatile, but that's where the SIP approach is helpful. By SIP, what you do is invest a fixed amount every month in a disciplined way. So his 5,000, he can begin in a good large cap fund, for instance, say Franklin Blue Chip or ICICI Focus Blue Chip, or even an index fund like Franklin India Index Fund Nifty option. Let him begin in that, and 5,000 every month will go there. For the other 20,000, again I would suggest equities only, but provided his goals are at least 4 to 5 years away, I mean, for whatever he is saving. So that other 20,000, again he can split into 10 installments of 2,000 each and invest in a mid-cap fund, say HDFC mid-cap or IDFC Premier Equity. So that way he will get a very the combined portfolio of large and mid-cap will, so there will be no overlap there. So I suggest you begin that way and then review the portfolio once a year.
Okay, so the advice, Saurabh Kumar, that is coming from Jayant is firstly with regard to that if you're looking at investing, look at investing through a mutual fund, as he explained to you, through an SIP, so a monthly money, the way your father must have given you pocket money when you were studying, you'll be giving that money to a mutual fund house to manage your money. So that is the advice that is coming. There should be a combination of large cap and mid cap. Always remember, equity investment, it's not about the time that you're investing, but the time period for which you're investing. So ensure that when you're looking at this investment, you're looking at a long-term horizon.
Investment Ladder, presented by BSC, Investors Protection Fund.
Well, on that note, we've really come at the end of this episode. Thank you, Jen, for joining us today. And thank you all for watching. And remember, we are waiting to address your queries. We are waiting to address any basic question that you have as far as financial planning is concerned. Thank you for watching.
The Financial Planner, presented by BSC, Investors Protection.